Many business owners cringe at the idea of knowing and understanding the language of finance. After all, isn't that what your bookkeeping or accounting professional is for? Yes, they're there to do the hard work for you, but getting up close and personal with some of the most important financial terms not only helps keep you agile as a business owner, but it can also improve your understanding of financial strategy and help you increase your income potential. Hi, I'm Karen Kinsinger. If you're new here and you don't know who I am, I'm an online bookkeeper who works with online service providers that are stressed out and frustrated about their bookkeeping to help them gain back time to focus on the revenue-generating activities and spend more time doing the things that they enjoy. Today we're talking about 10 of the most important financial terms that you need to know to help you grow a more profitable business. The first one is equity. Equity is the combination of your cash and other assets that you've invested in your company. It typically also includes any earnings that your business has earned since opening its doors. A very simple way to calculate your equity is to subtract all the money that your company owes, which is your liabilities, from the value of everything that your company owns, which is your assets. A positive equity is a good thing where lenders and buyers are concerned, and a negative equity can be a result of high debt, low profitability, or too many owner withdrawals, which leads me to the second term, which is draws and distributions. Now, some business owners choose to withdraw cash directly from their companies in the form of draws or distributions rather than paying themselves a salary. These personal financial payouts reduce the amount of ownership or equity that you hold within your business, and the result is reflected on your company's balance sheet, which is one of the most important financial statements. The third term is cash versus accrual-based accounting. In cash-based accounting, your revenues and expenses are recorded as they occur, or when your customers' payments are received and supplier bills are paid. But in accrual-based accounting, your revenue is reported as it's earned and expenses as they're incurred, regardless of when the cash changes hands. Many new or smaller businesses use a cash-based accounting because it's the more straightforward of the two systems. The fourth term is capital expenditures versus operating expenses. Your capital expenditures are the purchases or fixed costs that contribute to the value of your business. They often are your long-term assets such as software, machinery, vehicles, and buildings, and their purchase price is typically spread out over a number of years for expense deduction purposes. Your operating expenses, on the other hand, are your short-term, everyday costs that are fully deductible in the tax year that they're expensed, such as office supplies and business insurance. The fifth term is depreciation. Your depreciation is the amount by which certain assets are considered to decrease in value each year. For tax purposes, it only applies to assets that will be in use for longer than a year, things like your computers, your office furniture, and your long-term assets. It doesn't apply to land, which is considered to have an infinite useful life. Depreciation amounts can generally be deducted against your income on your company's tax return. The sixth term is your burn rate. Your burn rate is the rate that your business spends money each month, especially venture capital. It's used to determine cash flow, and it's calculated by subtracting your cash on hand at the end of an accounting period from the cash on hand at the beginning of that same accounting period, and dividing the number by the amount of months the period contains. So as an example, if you wanted to calculate your burn rate for the first quarter of the year, you would subtract the cash that you had on hand at the end of March from the cash that you had on hand at the beginning of January, and divide that number by 3, the number of months in the quarter. A negative burn rate indicates that you have a positive cash flow, or an increase in cash reserves. The seventh term is your cost of goods sold, or your cost of sales. Your cost of goods sold and cost of sales refer to how much it costs your business to make its product or provide its service. By knowing the amount of these direct expenses, you're able to determine whether or not your sales are generating a profit and how much of a profit you're generating. Reducing your cost of goods sold or cost of sales is an effective way to increase your profitability without having to increase your prices or sales volume. The eighth term is your gross profit and gross profit margin. Deducting your cost of goods sold or cost of sales from your company revenue tells you how much gross profit your business is earning. When you show that profit as a percentage of your revenue, that's known as your gross profit margin. If you had a consulting business that earned $200,000 in revenue last year and your cost of sales was $50,000, your gross profit was $150,000 and you had a gross profit margin of 75%. These figures are very useful for comparing your year-over-year profits. Now, the ninth term is return on investment, and this might be a term that you've heard before. Calculating the return on investment for time or money can be helpful in determining whether or not a product or process is a good investment. If you spent $500 on a specific marketing channel last month and your performance metrics indicate that the channel was directly responsible for $1,000 in revenue, the resulting ROI of 100% tells you that the marketing dollars were most likely a worthwhile investment. Your ROIs must be monitored closely, though, to ensure that your returns consistently measure up against costs. The 10th and final term is your intangible assets and goodwill. Every successful business holds some combination of tangible, physical, and intangible, intellectual assets. Your intangible assets like patents, trademarks, copyrights, and goodwill can be difficult to measure the quantity of on a balance sheet, but they must represent real business value nonetheless. If you sell your business, the size and quality of your customer base and any branding that you've established are considered part of its goodwill. Goodwill typically accounts for any difference between a company's tangible asset value and its selling price. So now you know the top key financial terms that can help you improve your understanding of financial strategy and increase your profit potential. If you're like most business owners, learning about bookkeeping is at the bottom of your to-do list, right next to actually doing it. Fortunately, it's one of the tasks that I highly recommend that you outsource to a professional, and even more so if you don't understand what you're doing. Not only do you run the risk of royally messing up your books, which ends up costing you more time and money down the road, but it also takes away time and mental energy from tasks that are much more enjoyable and increase your revenue. If you're a coach or service-based entrepreneur and your bookkeeping is leaving you feeling stressed out and frustrated, then we definitely need to talk about where you're at in your business, where you want to be, and what your bookkeeping needs are. So book a free discovery call with me using the link above and get ready to leave the stress and frustration behind and free up more time and mental energy so that you can focus on the revenue generating activities. So book your free discovery call with me using the link in the video's description. I look forward to chatting with you very soon.